Well, good afternoon and welcome from 39 Essex Chambers to episode 6 of 39 from 39. For those less familiar, this is a form of webinar in which within an hour, and giving each of our speakers 30 minutes or thereabouts to make their presentations, we try and share with you a particular topic of relevance at the present time, and no more so this afternoon than planning and viability, as we look at the proposed government's reforms in the context of where we stand at the moment in terms of delivery and deliverability. So without further ado, what I'd like to do is introduce the panel this afternoon. We have two particular additions to the usual lineup, because this afternoon I'm delighted to welcome Matt Spilsbury, the Head of Development Viability at Turley, and also inviting back Richard Harwood as well. Katherine, a number of you have met previously, and thank you so much all of you for joining me this afternoon. Unfortunately, Juan Lopez, who was scheduled to speak, has got overwhelmed with a particular piece of work at the moment, and Richard's very kindly stepped in. But since Richard was involved in Hoban Studios, we will get two perspectives this afternoon, that from Katherine, but also from Richard as well. Three other matters I just want to mention before we get underway. The first is that there is a Q&A facility, and we will try and answer your questions. If we don't manage to reach them, then do please feel able to email either through marketing or through our practice team as well. Secondly, there will be a recording made of this particular webinar. The slides will also be available as well, and those will be emailed to you or available from our website later on in the week, where thirdly, you will find some very useful material from previous webinars and indeed our podcast series as well. So without further ado, I would like to introduce you to Matt this afternoon, who's going to be talking about the outworking of the requirements of national guidance and advice, as well as the current RICS professional guidance and statements. That'll be followed by Katherine talking about Hoban Studios, and then Richard about testing viability arguments, giving some examples with which he's been involved. So Matt, over to you.
Thank you very much, John, and good afternoon, everybody. So firstly, I think it's important that we consider the economic context. Where are we now? The viability of development is intrinsically linked to the wider economy, which drives property market conditions. So what is that context? Well, it's relatively unprecedented, certainly in my professional life, and I imagine in the case of others as well. So what's happened in the past 12 months? Where are we now? Well, the Bank of England Monetary Policy Report for February 2021 provides near-term forecasting. UK GDP in 2021 Q1 is expected to actually be below 12% below its Q4 2019 level as a result of the lockdown measures we've experienced. Looking to the graphs on the right-hand side, as you can see, unemployment and inflation are expected to increase over coming months. So these are important near-term considerations, because employment rates drive consumption, which influence residential and commercial occupier demand and pricing. Inflation drives growth in development costs and finance costs via interest rates. And obviously the start-stop impact of COVID-19 will impact on the delivery and construction programs of specific schemes, which can increase cost and risk. So cumulatively, all these factors do actually drive development risk and investment risk, which will influence target returns through development. Next slide, please. So moving forward then, what's the economic context, the outlook? Well, again, turning to the Bank of England's forecasting, the picture is actually one of cautious optimism, which is a positive. So GDP is expected to return to pre-COVID-19 levels by Q4 2021. There's then strong growth in GDP of 7.25% forecast in 2022, which then levels off in 2023, and a return closer to the long-term trend at 1.25% per annum. In fact, slightly below the longer term trend. So subdued this year, but positive, strong year projected next year. So next slide, please. So what does that mean then? What's the implications for the various property sectors? So I've tried to give a relatively quick skim through here, so apologies if I'm not covering everything. So starting with residential, well, the residential market actually has been the biggest surprise of the past 12 months, completely contrary to the wider economic context. It's not only been resilient, but it's actually been strengthening in general, albeit not across all markets. So in particular, central London, city and town centre flattered development, other urban locations have faced decreasing demand and price pressures, rental pressures. Transactional volumes in 2020 and 2021 do, however, remain robust. And Halifax has actually reported a 5.2% year-on-year price increase in February, while nationwide has actually reported a 6.9% rise. So both of those rates well above respective 5-year averages, which is 4% for Halifax, 2.8% for nationwide. So very strong overall, driven predominantly by this race for space that we've seen and a suburbanisation, ruralisation out of town and city centres. So some forecasters remain quite optimistic for price growth. I've seen various houses forecasting for the next 5 years quite strongly. Others more cautious. I think it's important to remember the resi market's been buoyed by government subsidy, the form of job retention scheme, mortgage payment holidays, SDLT relief and the extension of Help to Buy, as well as the government backing of 95% mortgages. So the market's going to be highly sensitive to being weaned off fiscal stimulus over the next 12 months or so. Is the current boom a false economy? Well, I've not got a crystal ball, so I'm not sure, but everyone will no doubt make up their own minds. Couple of sectoral specific areas. So the build to rent sector, occupancy rates remained relatively stable. Rent collections didn't suffer like in some other sectors. Investment activity was slow over the majority of the last year, but has actually recommenced. And interestingly, investor appeal has increased in respect of co-living development, which is emerging as a sector in its own right. PBSA, so purpose-built student accommodation, has faced quite significant occupational challenges, which are well known, but is expected to return over the course of the next 12 months or so and attract investment in new development in prime locations. Turning to offices, well, offices have been quite hard hit. Headline rents at the moment have held fairly firm in primary centres, but there's been increased incentives that we've seen. So rent-free periods, fit-outs, financing for tenants. But overall, transactions, so lease transactions down about a third over last year versus the 10-year average. And average capital values reported to have decreased by about 3 to 5% in terms of the overall value of those assets. And in terms of investment transactional activity, 50 to 60% down last year on traditional averages. So it's an interesting market. Overall, it's been held in suspended animation. So it will be interesting to see what happens regarding occupier decisions around space requirements, locational factors. All that is to come and is very much dependent on vaccination rollout. So could be quite a difficult period in respect of the office market. Retail hit very hard, particularly high street retail. There's a real structural shift I think we've seen. We're not really expecting to go back to where we were before. There was already a trend, it's been accelerated. There's a high level of void, insolvencies happening, and I think the shift's going to be a move to shorter, more flexible lease terms and turnover leases as well. Those will impact on capital values negatively, particularly in the short term. From a development focus, I think it's going to be on asset repositioning. So for mixed use diversification in particular, for example, the picture you've got there on the slide is Hammerson's redevelopment of the Debenham store at High Cross in Leicester, which is a joint venture with Package Living for 300 build-to-rent units, and is a very good example of this type of repurposing activity. I think it's going to be more challenging in secondary locations, so there's likely to be a reliance on public sector funding to redefine those retail centres. The examples are the high streets funding that we're seeing through the Levelling Up agenda, and then welcome back funding, of which there was quite a small amount, but 56 million announced at the weekend. Logistics, I'm not going to say too much about logistics. It had a stellar performance in response to COVID-19 over the last 12 months. Take-up rates almost doubled year on year in 2020, and there's expected rental growth of say 2 to 3% per annum going forward, as well as yield compression, which will drive capital values in good quality, well-located places. So there's not likely to be a significant viability challenge in respect of logistics development. Finally, leisure and hospitality, again, hit very hard, particularly the hotel market. So occupancy levels very much curtailed due to COVID-19. There's going to be very fierce competition expected for visitors upon reopening. Occupancy rates are critical for operational profitability under the hotel's model. And it will be a fight for I think for the fittest, survival of the fittest, really. Consensus forecasting that I've seen is that assuming vaccination rollout is successful over 2021, domestic and international occupancy rates in the hotel sector is expected to recover by about 2024. So UK market hopefully back to where it was previously by that point in time. That's quite a long period of recovery. Pubs, bars, restaurants and other leisure venues face the strongest headwinds in my opinion, but there are prospects for revival if we see a good result as a result of vaccination and a removal of the restrictions that are in place at the moment. But again, it's going to be tough, I think, over the summer, and we're likely to see, I think, particularly in secondary locations and where there might be an oversupply of these uses, repurposing again of sites. For example, a shift towards residential conversion. Next slide, please. So that was a very quick canter through where things are at the moment, just my own opinion and taking some forecasts and evidence. So I think it's fair to say that we're in a very significant period of market instability, volatility. There are still very evident risks across multiple sectors. And I think that's quite important consideration in viability and important in plan making and also site-specific decisions around applications where viability is likely to be an issue. I think it's probably going to be of increasing importance going forwards. Therefore, it's very necessary that there's a robust evidence base in place, and we'll come on to that shortly. I think worth just stepping back and reflecting on what viability in the planning system is there for. So PPG states it's to secure maximum benefits in the public interest through the granting of planning permission. But that must be a balancing act. So plans must be deliverable, policies must be realistic and achievable, and there must be flexibility built into the system to allow for the kind of shocks that we may see through the economic volatility, through outside factors, unforeseen circumstances, and really that's what viability is there for. It's a release valve to avoid site stalling. Next slide, please. So what's there to guide us? What standards are in place? What guidance, legislation? Well, it's important to reflect that there is a robust and significant framework in place. And I've put a little diagram there, which is prepared by the RICS on the right-hand side of the slide you can see. Obviously, the framework starts with the legislation, but there is then National Planning Policy Framework. In practice, that's borne out through the Planning Practice Guidance on Viability, which is a sort of a handbook for practitioners. But the RICS has also stepped up, and they've produced very recently a set of mandatory professional standards which chartered members must adhere to. That's consistent with the NPPF and PPG, and that's in the RICS professional statement. It's called Financial Viability in Planning, Conduct and Reporting, first edition. It was actually, I say it was recently, time has flown. That was actually May 2019. And that sets out 14 specific requirements that RICS practitioners undertaking and producing viability assessments for planning purposes must follow. I would say it's essential reading for any stakeholders in the sector and represents the barometer against which all assessments must be measured through the process, the local plan process, but also in decision taking and appeals and such forth. We're also expecting an updated full financial viability and planning guidance document, which was consulted upon last year. I think given the current context, it's gone relatively quiet on that. I think it's being reviewed at present following the responses to that consultation. Next slide, please. So what are the key issues in practice? I'm not going into wholesale technical detail here, but there's obviously room for and time for questions at the end of the session. And I know some of my fellow speakers will be going into some further details on these matters. So if you do have any questions, please feel free to ask those. So I think it's plain to see there's an evolving context, and that's going to present challenges, I think, in setting deliverable local plan policies and still charging costs. I think there's also regulatory changes which represent additional burden to development in the form of costs, which need to be recognised. So it is a moving context, shifting sands. So, for example, two of those briefly are firstly, the amendments to the Community Infrastructure Levy Regulations 2010, introduced in September 2019. Well, these removed the pooling restrictions on Section 106 obligations to allow both SIL and Section 106 obligations to fund the same items of infrastructure. This has actually resulted in some cases in both Section 106 costs and SIL being charged on development, so additional costs such as highways, education and healthcare, which have added an additional cost burden that needs to be considered and reflected in viability assessments. And then more recently, the government's published in January 2021 its response to the consultation on building regulation Part L and the future home standard. So they've effectively specified that the option that they will take forward will result or requires a 31% reduction in house emissions. The cost of that is going to effectively equate to an additional it's about, based on the government's advice, about £2,500 per flat and about £3,100 per house. At the moment, these costs aren't going to be reflected in current building cost indices and therefore will need to be taken into account. So just a couple of areas to show where there's going to be increased costs. We also saw the tax announcement yesterday for a residential developer tax, which will effectively support funding towards cladding coming in circa 2022, so another cost. A couple of areas that I'll just touch on then also that are very relevant is the valuation process. So it is a detailed process in undertaking a viability assessment. The government leans towards and encourages a standardisation of that, but it's not possible in every element of that assessment, and there will still be room for professional opinion and disagreement and challenge. Couple of areas that are very pertinent at the moment are, of course, achievable current market values. We should base it in the current market, realistic current market construction costs. There's a lot of volatility in both of those, and there's some extenuating circumstances which must be considered. So undertaking a robust assessment and process in determining those two particular areas is important. Benchmark land value, another very big issue, which is one that continues to face challenges on a regular basis. So that's the calculation of effectively what a reasonable return to the landowner is for the site in question. And then the level of that should factor in a level of premium as well. So usually based on, well, now based on existing use value plus an uplift or premium. Then finally, risk adjusted market return for a scheme. Now, there's a higher risk profile that we're sat in at the moment. And as a result, that's having an impact on expected returns as well, or required returns. So those factors aren't fixed, they're moving. Finally, then, the system. So I think it's important that there's increasing transparency. There's a building of stakeholder trust through the system at the moment. I feel this is an area of planning which perhaps has been sort of less trust in than it should be. And the shift to the ICS to increase the level of regulation through professional standards that has been introduced is very important in that respect. You know, all surveyors must be held to account when undertaking this type of work, and I think it's therefore important that those undertaking this work are RICS regulated. That should give confidence to all in the process. Finally, implications on timescale for decision making. That is a big issue. So at the moment, it can be perceived, and it does in some cases, slow down the process if running a viability assessment through the application process. I think there's room to increase capacity, both in local authority and then also in those that review this type of work for local authorities. and also there's a need to probably increase skills both within the local authority themselves, but then potentially also through elected members as well to help them understand this process. Next slide, please. So very briefly, just some concluding thoughts there. I think it's fair to say we're in a period of very significant property market instability. There's going to be fluctuation in the near term. There's probably likely to be more volatility as we see fiscal stimulus being removed slowly and the UK economy being weaned off that. There's also the potential downside risks that we may see of a further wave of COVID, for example, or increased unemployment. It's all yet to be seen. So in that backdrop, development viability is expected, I think, in a short to medium term to actually increase in importance and relevance. It needs to be there, it needs to be robust to support and inform deliverable and realistic local plans against particularly this backdrop of increasing costs and risks to development. And it's there to form that release valve to avoid development stalling, plans stalling as well. But clearly there are challenges that remain: capacity, consistency and trust in the system, transparency. It's very essential that transparency is increased, but it's an inherently complex process. There needs to be an evaluation process that's followed. The RICS guidance and professional standards are there to support practitioners in that respect, and stakeholders should be aware of that. And ultimately, it is a valuation and viability assessment process, and it can't fully be standardised or removed. There will always be site-specific issues that need to be considered. Thank you very much.
Good afternoon, everyone. I'm going to pick up there by talking about the Hoban Studios case. Now, of course, we have got Richard Harwood here now too, who is the true Hoban Studios expert, having acted for the successful claimant in that matter. So what we thought we'd do is that I'll set out in basic terms the background to the case, what was decided, and some lessons learned, if you like. And then Richard will pick that up and add some of his insights, obviously being particularly knowledgeable about the case. And then, of course, I suspect people will have lots of questions on this matter, so we'll both be around to answer them for you. So just to set the scene, as it were, the claimant in this judicial review was Holborn Studios, and they are the leaseholder and operator of one of the largest photographic studios in the world in Hackney. And you can see I've put a photograph there of their premises from one angle, from the canal side. And essentially the interested party, who I assume was their freeholder, had and has, I presume, aspirations to redevelop the site for residential and commercial redevelopment. So what happened first of all, in round one of the litigation, a planning permission was granted in 2016, and it was successfully challenged by the tenant, Hoban Studios, effectively on the basis that there hadn't been a consultation on amendments to the scheme. So that was round one, and the first planning permission was quashed. And that's really where our part of the story begins, then with the second application that was made. And importantly for our purposes today, as part of that second application for planning permission, the applicant offered just over £750,000 towards off-site affordable housing. And that was not what policy required in the usual way for lots of boroughs in London. The expectation in policy is for on-site affordable housing, unless there are exceptional circumstances. So what the applicant did was to put forward expert viability evidence to try to establish that providing on-site affordable housing was unviable. And so it was justified in paying this sum of money as a contribution towards off-site affordable housing. Next slide, please. So there were two iterations of the viability assessment. The first assessment was published for members of the public to see, but the numbers were redacted. And the second version, the assessment as a whole wasn't published, but a summary of that assessment was. So the claimants, Hoban Studios, asked the council to publish the most recent assessment in full so that they could consider it, understand the basis on which this policy in compliant affordable housing offer was being made, and then make representations on it if it was appropriate in light of the evidence base. But to no avail, the full assessment was never published, and indeed the council went on to grant the planning permission, and that was in 2019. And amongst other grounds, amongst other reasons, it was challenged by the claimant on the basis of the limited and incoherent viability evidence, and indeed the failure to publish it in full, and that claim succeeded. So that's the background. I want to now look at the legal framework. So if I could have my next slide, please. The key statutory provision that we need to look at is Section 100D of the Local Government Act, which is concerned with the inspection of background papers. And in a nutshell, where a report is required for a council meeting, so here we're talking about an officer's planning report, there is also a requirement under this section for a list of the background papers referred to in that report to be provided in a list, and then for a copy to be made available of those documents for the public. And you can see there towards the bottom of the slide, sorry, the formatting's gone a bit strange, but effectively the definition of background papers are those documents relating to the subject matter of the report which disclose any facts or matters which, in the opinion of the officer, the report or an important part of the report is based, and have, in his opinion, been relied on to a material extent in providing the report. So, to paraphrase very crudely, if the background papers are, sorry, can we go back to the previous slide? I haven't quite finished. If the background papers are material, if they're important to the issues being looked at and decided in the report, then you're going to come within the terms of this section. But there is an important exception, and that's subsection 4 there. This requirement to have these background papers available for inspection doesn't count if the documents would disclose quote unquote exempt information. So the question then is, well, what is exempt information? And now if I could have my next slide, please. There are various types of information that fit this description, but the one we're interested in is information relating to the financial and business affairs of a person. So you might assume at first blush, oh, okay, well, that's the end of that then. Well, no, it's not, because that exemption only applies if, and this is the key part, in all the circumstances of the case, the public interest in maintaining the exemption outweighs the public interest in disclosing the information. Now, previously, the courts had taken the approach that it wasn't appropriate, generally speaking, for viability evidence to be disclosed in full. Well, really on precisely that basis, on confidentiality grounds, on the basis that it includes commercially sensitive information. And there's a line of case law on that which culminated in a case called Perry, and I've put the citation there. But what the claimant was arguing in this case is that there'd effectively been a material change of circumstances since then, and that public interest in that part of the statute I've just read out to you needs to be approached differently in light of that change. And specifically, what had happened is that the government had changed the policy framework around viability quite significantly. And in particular, paragraph 57 of the NPPF had been introduced, which no doubt you'll be familiar with it, but it says that viability assessments should be publicly available. And there's also then some more detailed guidance along the same lines in the PPG. Next slide, please. So that was the position, those were the arguments being made. What did the court decide? Well, the court thought that one of the key issues before the decision maker, before the local authority, was whether viability concerns justified the non-policy compliant affordable housing offer. So in other words, whether it was okay for the developer simply to make the off-site contribution. And given that that was the key issue, the judge concluded that at least some of the undisclosed viability evidence contained important facts or matters on which the report recommending the grant of planning permission was based. And so therefore we were brought within this category of section 100D. And on the face of it, these background papers, or at least some of them, a list of them had to be provided and they had to be made available. So the question was then, but does the exempt information exception apply? And the court concluded, in light of the changes to the policy framework that I just mentioned, that this exemption did not apply. And I've set out a really key quote from the judgment there, and I'll just read out the underlined bit. The interests which placing viability assessments into the public domain serve are clearly public interests, which in my view support the contention that such assessments are not exempt information unless the exceptional circumstances spoken to the PPG arise and a solely executive summary should be put in the public domain. So there was a breach of the terms of section 100D. The court then had to consider, could I have my next slide please, whether that breach was material. So for the non-lawyers, really that means, did this breach of the statute actually matter? So the council was arguing that even if technically there'd been a breach, it didn't really matter to the substance because there was enough viability evidence that had been disclosed by way of the initial redacted report and then the summary, which meant that the claimant, Hoban Studios, had enough information to be able to make meaningful representations on viability and on this affordable housing issue. The court rejected that argument pretty categorically. Really in a nutshell, because the viability evidence that was disclosed to the public was of such poor quality. And in particular, the court referred to inconsistencies in the material that had been disclosed and which couldn't be explained from the material that the public had. So just to give some of the main examples, there were different figures given within the documentation as to what the benchmark land value was. There was no explanation of how the benchmark land value had been calculated. And that's very much contrary to the approach that the PPG requires. It wasn't broken down into what part one was, the existing use value, and then part two, the landowner's premium. And indeed, the material available seemed to indicate that actually the wrong calculation method had been used. the old residual land value method rather than the existing use value, which is now what government guidance says has to be applied. So drawing that all together, the court, you can see, was not very impressed by this evidence, and they concluded, well, the judge concluded that the material in the public domain was inconsistent and opaque. And so on that basis, there'd been a breach of section 100D. It was a material breach, it mattered, and the planning permission was quashed. So turning then to my final slide, which is some key takeaways. And as I say, Richard will add to these. But I think the starting point has got to be, in light of the latest guidance, so the NPPF, the PPG, and now this decision in Hoban Studios, the starting point is that at least the primary viability evidence will have to be disclosed to the public in an unredacted form. And I would suggest that anyone preparing viability evidence or thinking about what needs to be disclosed should start with the expectation that everything will need to be disclosed in full. And actually, it's interesting speaking to Matt about this just briefly before we started. He said that following this decision, that's definitely the approach that he is taking. So in other words, it should be a surprise if something is not disclosed. You should assume that it is all going to be disclosed. Now, there may, in particular cases, be a justification for non-disclosure. And you need to think very carefully about your particular scenario. And you will need to show, if you want to go down this route, that there is particular information which is genuinely commercially sensitive. And I'd suggest that you need to be really intellectually rigorous and honest when you undertake that exercise, because the guidance now makes it clear that almost everything in most viability assessments is not going to be commercially sensitive because it's not specific to a specific developer. If there's a particular patch of land that's going to be developed, the viability inputs in developing that are the same if I were to develop it, if you were going to develop it, or if the developer down the street were going to develop it. There's no need for there to be any commercially sensitive information included in most viability assessments. There may be some cases where there is an exception to that, and the PPG gives some examples. It says exceptional circumstances, such as ongoing negotiations about land purchase, and information relating to compensation that may be due to individuals, such as right to light compensation. So you can see there, those particular inputs are specific to a particular developer and are commercially sensitive. But even where that applies, it's not the case that you just don't or block out the entire viability assessment. You need to identify really carefully what the commercially sensitive element is. And then what the PPG says that you do is to produce a summary, an executive summary of that particular information. And the PPG is quite specific as to how you go about doing that. So that effectively the general principle is that you're disclosing as much as you possibly can, and that the absolute minimum is kept from the public, and that when the public looks at the picture overall, okay, there might be a couple of small elements that haven't been included, but they can understand the broad viability exercise that has been undertaken and what the key inputs are. So as I've said, then it would be a case of publishing a summary which has got to comply with the PPG. The other important point to make about this, and one of the reasons that Hackney fell down in the Hoban Studios case, is that you can't do these things with hindsight, and particularly not to turn up in court and say that you've done them. if these sorts of decisions are going to be made about particular limited information that's not going to be disclosed, there needs to be very clear decision making, particularly by the local authority, as to what has been decided and why, with reasons. So if the information has been deemed commercially sensitive, why? There needs to be a contemporaneous document which explains that. The public interest exception. Why is it that the commercial interest, when weighed against the public interest element, comes up trumps? That may be a legitimate conclusion to reach, but that needs to be thought about at the time, a decision made and reasons given. My next point I've sort of touched on, but the viability, this is then about the format of the viability evidence and its quality. It needs to identify really clearly the various inputs, the key figures, and explain how they were calculated. So for example, benchmark land value. It needs to give clearly what that figure is, and then a breakdown as briefly as possible how it was arrived at. And then I've said to prepare viability evidence on the basis that an educated member of the public should be able to follow it. I think that's a really good general principle, both for the experts who prepare these reports, but also for decision makers, whether it's me as a lawyer or a planning officer in a local authority, whoever it may be. I am not by any means a viability expert. I'm not somebody like Matt, but when I get a report, if I don't understand it, alarm bells should ring. Okay, it's a difficult concept and I probably need to concentrate quite hard to understand it and get to the bottom of it. But if ultimately I can't, or I'm really struggling, and this will apply to pretty much everybody listening, raise that early. And in all likelihood, that is not because you're unintelligent or you're failing to understand or apply yourself. It's because the report has not been written clearly enough. And if you can't understand it, then decision makers probably can't understand it, and a High Court judge is unlikely to understand it. And even if he or she can, they're unlikely to be impressed by it. So that's a good test to apply. And then I've just said at the end, remember clever people make difficult concepts sound simple. In my experience, that is generally true. It is a real art to be able to explain something complicated, difficult, and technical in a way that is accessible and makes it sound straightforward. So if a viability report is easy to understand and makes the viability assessment seem simple, that is because, in all likelihood, the person who's written that report is a really skillful professional. And so that is what they should be aiming at. May seem a bit counterintuitive, but rather than making it seem more complicated and difficult, if they've made something so difficult come across as relatively straightforward, then they should be commended for doing so. And that's what they should be aiming for. So I think that's all I have to say for now. I will pass over to Richard, who no doubt will have some interesting things to add.
Katherine, thank you very much. I'm just going to sort of chip in a few thoughts on viability from the perspective of the issues we had in Holborn, and also which have come up in a number of cases. And John, if you want to move on to the next slide, please. Just as an example of where viability, or the equivalent process of looking at development appraisals, comes up, yes, in terms of setting community infrastructure levy, establishing policies which rely on a viability assessment, handling of applications, dealing with affordable housing and 106s, enabling development in the context of heritage schemes, development in the grounds of listed buildings and the like. But also it comes up in dealing with compulsory purchase orders, which are reliant on a commercial developer carrying out the scheme. So is it a viable project to proceed with? And it will arise in the context, looking at development appraisal in the context of land compensation for compulsory purchase, both in terms of valuing and also in terms of the likelihood of something happening. And that goes into negotiation of damages as well. Viability has also been raised where a regulator has to look forward. So the Thornton and Oil and Gas Authority, the regulator needed to have regard to the ability of somebody who's going to have the benefit of a petroleum license to meet the decommissioning costs of the onshore wells in due course. So a number of different contexts, several of which actually show quite sort of close consideration of it by the court. But if we move on to the next slide, I wanted to sort of pick up on a couple of the lessons from the documents in Holborn Studios, because the court established that it needed to be made available. Second question, as Katherine identified, was did it matter? And why did it matter that various things had to be produced? One is simply the question of understanding what the available documents were saying. So the development appraisal, which was put in, referred to residualized price, which suggests that the appraisal calculated that. And when we came to the permission hearing in the High Court in front of Mrs. Justice Leven, Natalie Leven, as was, she said to the submission from the council, that was the benchmark figure that had been slotted in as a benchmark figure. How could any reader of the documents know that? And she was also, and as the judge in the substantive hearing later on, saying these documents the published documents don't make sense. And Mrs. Justice Leven made the point, as a formerly experienced planning barrister, that if she couldn't understand the figures, she didn't know how any even well-informed member of the public could be expected to do so. So can you actually understand what it is? Next slide, please. Related question, I suppose, is does the council understand the figures which it's been given? And in Holborn Studios, the affordable housing figure the offer had been changed with no explanation discernible from the papers. There are a number of different figures that were floating around for benchmark figures, one of which was introduced in an update report handed in shortly after the committee meeting had started. And the council's explanation, both at committee and then in subsequent evidence, was different and inconsistent with the documents. So you need to make sure that from the council that you do understand it, and from the developer perspective that you're putting forward figures which the council officers or their consultants are able to understand and able to explain. Some of the photos I'm putting up, by the way, are taken at Holborn Studios as part of the portfolio which they have. Moving on to the next one, please. Missing material, which was a problem in Holborn Studios, things which weren't expected, how the benchmark land value was made up, wasn't disclosed. The later explanation, which produced in a witness statement, which didn't have accompanying documents, that gave two bases it was worked for existing use value. One said to be the value of the current lease, and the other the value of the site with a potential future commercial lease. Now, as the current lessees, Holborn Studios potentially had quite a lot to say on those topics about what value you put on the current lease in terms of effective break clauses and the like. And also the the sort of occupier of the Holborn Studios scenario generated a significantly higher existing use value, it was said. But that was all based on, one might say, sort of building up the attractiveness of the current facilities, whereas the developer had put in employment assessments which were designed to demonstrate that the current facilities were not commercially very attractive. So there is a danger of, particularly of undisclosed documents, being used in ways inconsistent with the overall position. Next one, please. So looking more generally, what sort of things to be looking at and thinking about? The judgments about what the development value should be can be difficult. It's particularly valuing properties in the future. And there are some cases, one I've seen relatively recently, where the house price, which properties were subsequently marketed for, was very considerably greater than the figure that which had been used in the development appraisal. Now, there may be a very good explanation for that, but I think there is a case for a bit of looking back at some development appraisals just to see whether the projections they put in were right, and that could be a learning experience all round. Build costs, to an extent, generic, but often going to be obviously site-specific. Question how far you need to get into those, and the role of expert advice is going to be quite critical in that. But again, picking up one of Katherine's points, quite often problems with development appraisal can be worked out by somebody who's moderately well informed, just working hard trying to understand where the figures have come from. And land acquisition values, I picked up on some of the problems which are generated on those assessments. And I think particularly the need for consistency in how you look at it. Next, I want to pick up on a couple of cases and issues. So, John, a recent Lands Chamber decision, which was looking at compensation for compulsory acquisition of an amusement arcade, gave a bit of a warning against perhaps inappropriate use of some of the residential development appraisal software as being a bit too sophisticated, and also, in the tribunal's views, leaving out much of the essential detail, obscured from view. Now, I think they ultimately got to the bottom of what that material was, but do look, even if you're using standard software, at whether somebody is capable of properly understanding how things have been worked out. Next one, please. A Scottish case, which is in the context of a damages claim under a servitude, so essentially a way leave. Losses caused by a pipeline through property, oil pipeline might go bang, and that, it said, prevented a 5-star hotel development on the site. The court dismissed the claim. There was a serious problems in the evidence as to what it was, the valuation purpose in particular, were being assessed, which is inconsistent with various planning schemes and the like. So there's often a problem, a need for clarity of what is being dealt with. And the court ultimately found that what was proposed was unbuildable and going to be unviable. So the damages claim failed. And it's a good illustration of how some of these things are picked up. I think my final slide next, John. Going back to a CPO case, it's a relatively old case, sort of about 14 or 15 years ago, but it's concerned a compulsory purchase in Brighouse in West Yorkshire for a retail scheme on a central site. One of the issues was the viability of the scheme. Was there a likelihood that the scheme would proceed if the order was confirmed? And given it was developer funded, that went to viability. Now, viability was, pseudo development appraisals were put in from both sides, assessed and heavily cross-examined on. And the developer's profit figure in their own evidence fell from 12% to the close of cross-examination, 3.7%, which the developers, the acquiring authorities, witness accepted, made the scheme unviable, and he accepted that a developer would be bonkers to proceed with the scheme. So the Secretary refused to confirm the order on viability grounds. And it's an illustration of the need to get these as right as they can be, and the way in which on detailed analysis things can fall apart. So if you're preparing them, trying to find ways of avoiding that happening. So those are a couple of thoughts from me. I think what we'll do then, hand back to John and see if we can deal with a couple of questions.
Thank you very much, all. Thank you, especially Matt and Richard, for those insights. Katherine, it was a pleasure, as always, to hear your practical common sense approach to a case like Hoban Studios, a bit like the judge as well. So turning to questions, we've had one on Hoban Studios already this afternoon about the extent to which, as it were, the honest developer disclosing his report, willing to sign up to section 106 that's policy compliant, needs to basically go through the Hoban, as it were, ringer or fine sieve. Thoughts, please.
Shall I kick off?
Let's go first, Richard.
Yeah, okay. I mean, viability matters on a planning application if you're looking for an excuse for non-policy compliant development. Really, that's if you're not providing the affordable housing, if you're finding enabling development. I know there's a desire also for something of a benchmark, but if you can avoid having to do development viability appraisal, that's probably the best way of dealing with it. So that's the sort of just my quick thought on that question.
Thank you very much. Matt, anything you'd like to say from the surveyor's perspective?
I don't think so, to be honest, on that one, John. I think we've covered it through the presentation, haven't we, in some quite significant detail. Unless Katherine wants to elaborate on anything from a legal perspective in that respect.
Well, can I ask you a practical question, Matt?
Yes, of course you can. Absolutely.
As Katherine made mention, if I can characterise it this way, the approach since Hoban is, I wouldn't quite say honesty first, but certainly to err on the more generous side. What's prompted that? Bear in mind, as it were, the commercial imperatives that sometimes are placed upon you as to what you have to dispose and what you should dispose, as it were, and what you may dispose.
Well, I think the Hoban case has obviously given rise to quite significant commercial risk. So it's evident that if the applicant or appealant in those circumstances hasn't disclosed the full information and made it very clear and understandable to the local authority and to other stakeholders, wider stakeholders, that there's a significant risk of, firstly, there's presumably a risk of refusal, but then quite clearly there's a risk downstream of legal challenge, which will increase commercial risk, cost, and therefore I think there's a sensible set of decisions that have been made, in my experience, by clients, so developers and landowners, in disclosing information such forth that they are at limited or lower risk and mitigating that risk of challenge going forward. And I think that there's Hoban, but then obviously there's PPG as well, which advises transparency, drawing down from the NPPF as well.
Yeah. Now, applying the Barnes test, if I can call it that, or if it's readable to me, then it should be readable to a member of the public, but in all seriousness, making something user-friendly. I mean, what experience have you had of that? Because I have to say, reading some reports, they're long on the software and the outputs, but short on the explanation, as though somehow the reader has a pre-knowledge of the finer points.
Yes, I think that's probably a fair point. There's I think a long-standing perception that viability assessments are written by surveyors for surveyors, which obviously isn't actually the case. And that's, I think, probably partly taken from the way that it's drawn through from valuation, that it's, again, a valuation written for a valuer for financing purposes, for familiar with the terms. What I'm increasingly seeing, and what I'm trying to do, is to at least include up front an executive summary, which obviously ties back to PPG, which is very clear and sets out the assumptions so that somebody can work through literally within 1 to 2 pages, all of the key assumptions that are included within a viability assessment, and they have those financial figures. Then within the report itself, there should be sufficient explanation around each of the input assumptions that are applied within the appraisal, such that it's easy for a reader to cross-reference against the actual financial appraisal that should be appended to the document as well. So I think the idea is that the level of ease for the reader is increased, firstly through clarity up front in terms of the actual inputs and the output, and then a greater degree of explanation. And then there should be, of course, supporting comparable or calculated valuation evidence to support the assumptions that have been included as well.
Yeah, that's really helpful. Thank you very much. Well, we're nearing the end of our time, but I think, Richard, there are a couple of questions that have just come in, which you perhaps would like to tackle.
If I try and whip through and see what we pick up. First of all, a question really about whether the suggestion that the viability appraisal might agree a benchmark value, say 5 million, market price actually paid might be 10 million, possibility of developer running effectively 2 sets of books for that reason. I think the reason why we were into sort of benchmark values is to try and avoid a situation whereby the market is pricing development land in a non-policy compliant sense, that the land is being priced on the assumption that it won't provide the affordable housing which is required by policy. And the aim with the benchmark land value and EUV plus is to try and sort of force down that position to avoid the point. And Mr. Justice Holgate makes a point in Parkhurst, his judgment there. You just read the homily at the end is the best bit to have a look at. That if you put in prices which are paid, which assume that development's going to be non-policy compliant, you're never going to get the affordable housing that policy is expecting. So it ought to start sort of equating, and the planning system will say it's a bit tough if people have overpaid on that. I'll just move quickly on to the second question and made lob it, which is just a premium on existing use value brownfield, certainly suggests no expense, generally speaking, order of 10 to 30%. What premium is allowed on EUV for agricultural land? I mean, Matt's probably far better qualified than me to say, but I'll quickly venture the suggestion that on the big strategic sites in the southern part of England on greenfield sites, you may be looking at £250,000 an acre, so essentially 10 times agricultural land value, which actually is what the Let Win review suggested might be a good benchmark. But Matt will have a far better answer than I have.
Yes, I think you might have mentioned, sorry, Richard, £250,000 per hectare, was that, or 100,000?
Yeah, sorry, per hectare, yeah.
Yeah, that would be a lot per acre. Very
sorry,
bad.
yeah, sorry.
Well, I think I'd agree with Richard there. I think we tend to see £100,000 per acre as being the sort of the minimum level to release greenfield strategic sites, which is based on the minimum levels in option agreements. That's fine on larger scale sites that have got significant gross areas of development, and the net developable area is say 50-60% of the gross, but and have potentially have large areas of strategic infrastructure requirements and other costs. But actually, when you would get to smaller sites that perhaps have a greater level of developable land and a lower burden, then you would expect that value to increase. I think one of the issues that we're seeing at the moment is there seems to be this drive towards £100,000 per gross acre on all sizes of sites through the local plan process, SIL viability testing.
Yeah.
My concern with that is that that's going to cause an issue in respect of the reality of landowners' expectations and the actual burdens that are placed on that land. And there being a bit of a conflict between the two. So that, in my view, there should be a view to also cross-check against market evidence, which PPG does recommend. I think that should be quite a strong cross-check, and there should be a view of transactions of greenfield sites, but where those are not policy compliant, they should be reweighted to ensure they are policy compliant, and there should be a general reweighting across location, value, and other cost factors to ensure that there's a consistency. That would mean that you could produce a comparable set of transactions which would cross-check the benchmark land value on a like-for-like basis. My concern at the moment is there's a bit of a very simplistic approach being taken in some cases just to revert to £100,000 per gross acre, which is just misrepresentative of certainly small and medium-sized greenfield sites.
Yeah, that's very helpful. Thank you very much, Matt. Well, we're nearly out of time, but there is a question that's coming on local plan viability and really how much evidence needs to be given at that stage, because I know there's been concern about an overly light touch. Equally, giving too much too soon may fix your scheme too early. Any thoughts on that one, panel?
I'll jump in if anyone. Yeah, okay. I mean, I think my concern, or my view in respect of that, is that there has typically and historically been a reluctance from developers and land promoters to include viability evidence of the local plan process within the local plan process, because effectively there's a beauty parade situation and nobody wants to be raising any potential issues around viability at that stage. However, there's obviously an onus in the NPPF on local plan policy being deliverable and viable. And that policy costs shouldn't be set at a level which precludes sites coming forward. Alongside that, there's also needs to be consideration that there'll be an expectation that if an application is submitted, let's say subject to allocation, downstream for, let's say, a strategic site, that site will bring forward the level of affordable housing and other 106 obligations consistent with that which was set out during the plan making process. So there's a risk that if evidence is not put forward to suggest that if there is a disagreeing view with the level of policy cost that's emerging through the plan process, that developers may leave themselves and landowners in a difficult position. They're trying to argue actually they can't meet those costs downstream. So there's a two-way process there. I think there needs to be greater level of scrutiny at that plan making process, through that plan making process at that stage. Developers do have to disclose that information and do have to put down their views and set those out. Admittedly, I know it can be costly and there can be quite a lot of technical unknowns, but it's important that that's set out there and those markers are placed, because if you don't, then there's going to be quite significant issues potentially downstream if you then have a situation where you can't deliver the level of policy that you've effectively signed up to. Yeah.
Well, and can I just add it there that there's the application of the Barnes test again, because my experience is that local plan inspectors do struggle on issues of viability, and certainly the local authority oftentimes is under-resourced in terms of being able to, as it were, present their side of things. So all the more important that matters are done in a way that's effective and also communicates the message. Well, we're out of time now. Thank you so much for watching this afternoon. Please do look at our website for continuing webinars, podcasts, articles, newsletters, and indeed the way in which we can continue to serve during this diminishing lockdown. So it leaves me to say good afternoon, thank you for watching, and happy Easter. Thank you. Bye-bye.
Thank you. Bye.